All right, let's talk about RPM International. They just put out what, on the surface, looks like a fantastic earnings report for their first quarter. We're talking record revenue, record earnings, so you'd think the stock would be flying high, right? Well, that's not exactly what happened, and that's the big puzzle we're going to dig into today. Yeah, check this out. The stock actually finished the day down, a beat on the top and bottom line, and the market says, nope, not interested. So what is going on here? What are investors seeing that the big, shiny headline numbers might be hiding? Let's get into it.
So first, let's just look at those headlines because they really do look great. Revenue came in at $2.11 billion, which was ahead of what Wall Street was expecting. And adjusted earnings per share, same story, another beat. You really can't argue with these numbers. It looks like a clear win, plain and simple.
Okay, so here's how we're going to break this all down. First, we'll tackle what I'm calling the muted beat. Then, we'll look at the bull case, this whole pivot to growth idea. After that, we'll flip the coin and get into the bear case, which is all about margins. And finally, we'll wrap it all up with our take in the next call.
All right, first up, the muted beat. This really gets to the heart of the matter, right? Why did a record-setting quarter get such a skeptical reception from the market?
And this quote from the CEO, Frank Sullivan, really says it all. He is basically drawing a line in the sand. He's saying, hey, while everyone else is scared, playing defense and cutting back, we are going on offense. We're hiring. This idea, this aggressive strategy, is the key theme from the whole earnings call. It's a really big deal.
So that brings us right into the bull case. It's all about management's pivot to growth. And believe me, this is the story they really, really want investors to be paying attention to.
And look, this isn't just talk. They are absolutely putting their money where their mouth is. We're talking an extra $5.3 million on new sales staff, another $3.2 million on advertising, plus $2.1 million to get ready for acquisitions. They're not just hoping for growth, they are going out and actively buying it.
So, does it work? Well, what's the payoff for all that spending? How about a 7.4% jump in revenue year over year? Now get this, management themselves called the current environment frustratingly no growth. So in a world where nothing's growing, they're managing to manufacture their own. It's tangible proof that the bull strategy is working, at least, on the sales front.
Okay, but if the revenue picture is so good, what's the problem? Why did the stock drop? And that, my friends, leads us straight to the bear case. Because this isn't about sales. This is all about what the market is worried about, margins and profitability.
And this slide, right here, this is the entire debate in a nutshell. It is the bulls versus the bears. The bulls are cheering that awesome 7.4% revenue growth, but the bears, they're pointing to the profit margin, which actually shrank by 70 basis points. They're asking the critical question that's spooking the market. What good is all that new business if you're making less money on every sale?
So let's peel back the onion a little bit. Where's this margin pressure coming from? Well, the main culprit is what's called SG&A expense. First, there was a big, unexpected jump in healthcare costs, to the tune of $8.8 million. Ouch. And then you have those deliberate growth investments we just talked about. The new hires, the advertising, that all costs money, and it's hitting the bottom line right now.
And on top of all that, you've got these temporary costs. See, RPM is doing something smart for the long run. They're consolidating 6 different plants. That's great for future efficiency. But in the short term, it dinged them for about $10 million this quarter. And if you're an investor focused on today's profit, that's just another red flag.
And then, as if to prove the bear's point, management themselves poured a little cold water on things. They actually trimmed their profit growth forecast for the rest of the year, pointing to economic uncertainty. So when the company's own leadership signals they're being cautious, well, you can't really blame the market for feeling the exact same way.
Okay, time to bring it all home. Let's move to our final section, the next call. This is where we put all the pieces together and give you our take on what's next for RPM.
So we've looked at the bull case, this really aggressive growth plan that's absolutely driving sales, and we've looked at the bear case, shrinking margins and a cautious outlook. So where do we land on this? What's the verdict on the stock?
We're calling this one a market perform. And really, what that means is that the bulls and the bears are kind of in a standoff right now. Look, the company is doing exactly what it said it would do. They're growing the top line, and you have to give them credit for that. But the market's concerns about how much that growth is costing are completely valid too. So until we see clear proof that this growth can actually lead to better profits, we think the stock is probably going to trade right in line with the broader market.
So looking ahead to the next earnings call, what should you be watching for? What we expect to see that revenue number keep climbing, probably in that mid-single-digit range, as these growth plans keep firing. But on the flip side, we also think those margins are going to stay under pressure. The spending isn't going away overnight, and what that probably means is the stock stays kind of stuck in a range, just waiting for that aha moment when the company proves it can turn all this spending into real sustainable profit growth.
And finally, our obligatory disclaimer. This is not financial advice. But for those interested, here's one way to think about this setup. It's a pair trade. You could go long RPM stock while at the same time shorting a broader industrials index like XLI. The idea is to bet that RPM-specific growth plan will help it outperform its peers who are mostly just cutting costs. Now, what's the risk? Well, a major economic downturn could sink all boats, or maybe RPM's big spending just never translates into actual profit. And that right there, that's the #1 thing to watch for on their next call.